solve for yield to maturity, or YTM. Sometimes, like in real life, we actually know how much bonds sell for, which was our bond value calculation from the early slides. And sometimes what investors are interested in is calculating the implied yield to maturity, which is like the rate of return on your money every year, or the IY in the financial calculator. One way to calculate it is trial and error using the formula and trying different interest rates until you get the present value that is known. But of course, there is a way to do it very easily in the financial calculator. Let's look at the following example. Skyfall Company issues corporate bonds to raise money for a new investment project. So it would like to borrow money, essentially. The bonds that this company issues have the following characteristics: 10 years to maturity, 9% coupon rate, coupons paid semi-annually, and the company can raise $880.50 with each bond. What is the yield to maturity? Okay, in the financial calculator, we are given 10 years, but we are going to have to input 20 for the number of coupons, right? Just like before. For the PMT, the coupon amount, every year, we need to do 9% coupon rate multiplied by 1,000, which gives $90 per year. And then to make it semi-annual, we divide $90 by 2 and get 45. So that's our PMT. Then, as always, the future value is $1,000. And this time we are given the present value, which is $880.50. And we are gonna have to compute the IY, the yield to maturity, in this problem. Notice one important thing. We are given $3 amounts, the PMT, the FV, and the PV. What do you do with the signs? Everything that's today is one sign, everything that's in the future is with the opposite sign. For example, the way I put my signs here is I left both PMT and the future value, which are both in the future, as positive, and I changed the sign to a negative for the present value. But you can also do it the other way around. When you do that, you will get 5.5%. It looks like this is our answer, right? Actually, it's not. We are missing one more step. Why? What's going on here? Because everything in our problem is semi-annual, the interest rate we get is also semi-annual. So 5.5% is for half a year. And what's really meant by yield to maturity is the annual interest rate, the annual yield to maturity. And so the last step that we need to do is multiplying our answer by 2 to convert the answer to its annual equivalent. And so 5.5% per half a year multiplied by 2 gives 11%. This is the right answer. Let's do this math in the financial calculator. Let's bring it up, turn it on. First, let's make sure it hasn't stored anything from any earlier calculations. Let's reset it. Second, plus minus, enter. We can also increase the decimal places. And we do that by pressing second decimal place. Let's make it 6. 6, enter. And I just turned the calculator off and then back on. And the calculator is now going to round everything to 6 decimal places. So we need to solve for the yield to maturity, or IY, in the financial calculator. And we need to enter the number of coupons, which is 20. So 20N. Then the coupon amount itself, or the payment, PMT, is 45 PMT. Because I left it as positive, my $1,000 face value or the future value should also be positive. So I put 1,000, and without changing the sign, I press FV. And only for the bond price or the present value, I'm gonna change the sign to negative. So I put 880.50 negative PV. And I'm computing IY, compute IY. So we get 5.499965. If you round it to 2 decimal places, we will get 5.5, like on my slide. And then you multiply that by 2 and get the annual yield to maturity, 11%. Bond features. So a bond is like a loan. A company that sells a bond borrows money from whoever bought the bond from the company. Indenture means a written agreement between the company that borrowed money and bondholders who lent money, the creditors. This written agreement includes a lot of conditions and terms. Let's look at the most important ones. The most basic ones are terms of the bond. For example, what is the face value amount? Usually it's $1,000, but it could be something else, for example, $100,000. There are bonds like that. Then how many years are left to maturity? When, on which dates the coupons will be paid to the bondholders? What is the coupon rate? And so on. Security. Bonds are called secured if they have some sort of collateral in case the company cannot meet its obligations and pay the coupon and the face value to the bondholder. So what could be a collateral? Maybe if the company cannot pay cash as coupon payments, it instead pays in stock shares. Or maybe it uses something else as a collateral, maybe some sort of accounts receivable. Unsecured bonds are also known as debentures. And this is basically what this whole chapter is on. We never talk about any sort of collateral. So it's more like unsecured bonds are like, just a promise from a company, from the company that sells the bonds, that it will make the required coupon payments and the face value at the very end. Technically, in this chapter, we call all the different types of bonds as bonds, but anything that has less than 2 years to maturity is also known as bills. 2 to 10 years to maturity is also called notes. And anything with longer than 10 years to maturity is just bonds. But all of this combined is also called bonds. Another thing that could be included in the indenture is the type of seniority on these bonds. Bonds are called senior bonds if they are older bonds. They have been issued way back when. So maybe a company issued bonds a few years ago and today decided to issue more. Those bonds that were issued a few years ago are senior bonds. Those that are about to be issued are junior bonds. So those investors who bought the senior bonds that were issued a few years ago, they have a preference in receiving payments over those investors who are going to be buying the junior bonds. So the junior bonds are basically more risky. They present more risk to those who buy them because there is a chance they will not receive their promised coupon payments in the face value, since they get the second priority. Repayment. So we have a company that sells bonds. We have investors who buy those bonds. There could be a third party, a sinking fund, like a third party between the company and the investors. The role of a sinking fund is the company will be making annual payments into this sinking fund. So it could be some sort of bank. And then this bank, this sinking fund, will use the money that will accumulate in it to, so to speak, retire part of the bonds. In other words, it will buy them back from the market, from the investor's hands. They're no longer circulating, among the investors. They're removed from the market. And this is called as calling bonds. And the point of that, so why would the firm want to use this kind of option to call the bonds? Because if there are fewer bonds in the market, then it's like the firm has less debt. So this may improve its credit score, which is good for all sorts of different things. These sinking funds may be used after several years. And some bonds have this provision of the possibility that they would be called sometime in the future. Types of bonds. So let's look at different types of bonds. But of course, we're not going to be talking about James bonds, but instead corporate bonds or government bonds. So bonds can be of different type. On this slide, I'm summarizing the types of bonds by issuer. Who may issue a bond? A corporation or a government. So there are corporate bonds, there are government bonds. The government bonds can in turn be issued by the federal government, and those bonds would be known as treasury bonds or treasuries, or they can be issued by more local governments, such as State of California, City of Pomona, and those are known as municipal bonds or munis. And again, there are different variations in how bonds may be called. Bills, if they have less than 2 years to maturity, notes, if they have 2 to 10 years to maturity, and simply bonds if they have a longer time to maturity. How do corporate bonds and different types of government bonds differ in terms of risk of default? So what does risk of default mean? Defaulting means you're not able to make your payment. So who are we talking about? The issuer, a corporation or a government. So in which case do you as an investor who bought a bond face this risk of default? If you bought a corporate bond, you face a low to high risk of default, because any company can go out of business. It may go bankrupt, it's out of money. So you may not get your coupon payments. In case of the government bonds, the risk is smaller, and there is no risk of default if you buy federal government bonds. In other words, you will get your coupon payments and the face value in the future. But if you buy local government bonds or state government bonds, there may be a chance that the state is out of money. The state budget is low, and you don't get your coupons, maybe not for a while. The second thing that makes corporate bonds and government bonds different from each other is whether you as an investor who buys such bonds need to pay taxes on your coupons, because coupons that you receive is your additional income, right? Is it taxed or is it not taxed? Yes, it is taxed if you bought corporate bonds or federal government bonds, but your coupon income is not going to be taxed if you're buying state and local government bonds. So see how all the different bonds are different in many different ways. Let's look at this example in which the whole taxability of coupons on bonds is analyzed. Spectre Corporation has bonds that give a 7% return per year. So that's their yield. Municipal bonds that an investor could buy instead yield a 5% return per year. So let's say we have investor James, who is in a 30% federal income tax bracket, right? So any income is taxed at 30% rate. Would he prefer buying Spectre Corporation's bonds or the municipal bonds? So at the first glance, it looks like his return would be higher if he buys the Spectre Corporation's bonds, right? So we are talking about 7% being above 5%. But wait a second, remember, corporate bonds are taxed. So it could be that after taxes, the return on these corporate bonds is below 5%. So let's check that. So we need to compare the after-tax or the effective returns to this investor. Corporate bonds are taxed, and so after taxes, the return will be only 4.9%, which is calculated by taking the before tax return, 7%, which is given, and multiplying by 1 minus 0.3, the 30% tax rate. And the municipal bonds are not taxed. The coupons received from municipal bonds are not taxable. And so the effective rate is as given, 5%. And now you can see which bonds would be more desirable for this investor, James. It's the municipal bonds with a higher after-tax return. There is another type of calculation that could be done when we are comparing bonds with taxable versus bonds with non-taxable coupon payments. For example, we can calculate at which federal income tax rate an investor would break even. In other words, be indifferent between buying corporate bonds and municipal bonds. And what we need to do is basically set equal the after-tax yields. So after-tax yield on the corporate bonds with the 7% yield that was given would be equal to 7% multiplied by, open parenthesis, 1 minus some tax rate, close parenthesis. And that needs to equal 5%, which is given for the municipal bonds. So we are asked essentially to calculate the tax rate that would make both sides equal to 5%, right? The after-tax return on the municipal bonds is 5% as given, and so is the after-tax return on the corporate bonds. To solve this little equation, we can first move 0.07 to the right, and mathematically we would be dividing 0.05 on the right hand side by 0.07, and now on the left hand side we are just left with 1 minus t, and then we want to have t equals and then everything else, so we want to get rid of 1, and the easiest way to do it is to leave t on the left hand side. Actually, I first simplified the fraction. So 0.05 over 0.07 equals 0.7143. And then t will equal 1 minus 0.7143. And when you simplify it, you get 0.2857. In other words, the tax rate that you would need to face in order for you to be indifferent between buying corporate bonds and municipal bonds would be 28.57%. And this is kind of the general formula that you would apply in problems like this. So to find the break-even tax rate, you do 1 minus a fraction, where in the numerator you have the percentage yield on municipal bonds, and in the denominator you have percentage yield on corporate bonds. Next, we can group different bonds into how into different categories determined by how coupon payments are made. So coupon bonds is what we have had in this chapter so far, and we will look at coupon bonds until the end of this chapter. That's when there are coupons, and that's the most common type. So there are coupons periodically, typically every half a year, right? Semi-annual coupons, with the face value paid at the very end. There are bonds which have no coupon payments. They're known as zero coupon bonds or zeros. So there's just the face value at the end and one large interest payment together with the face value. Then bonds that do pay coupons can further be differentiated by the coupon rate. Level coupon bonds have a level coupon rate. So what does level mean? On the same level, flat, so unchanged or fixed. And that's also what we've been using in all our numerical examples in this chapter. So it's the same coupon rate which we then use to calculate the same amount of coupon payment paid regularly. Other bonds in real life have a floating coupon rate. So those are known as floating rate bonds or floaters. So the coupon rate sort of floats. It goes up and down. In years when it's high, we have a high coupon payment. In years when the coupon rate is low, we have a low coupon payment. So the coupon rate is adjustable over years. What could it be linked to? It could be linked to sort of the cost of living or inflation. So if the prices are higher, then investors would want to be compensated with a higher coupon payment to them, right? And in those years, the coupon rate will be adjusted up. Now that we mentioned the word inflation, let's talk more about inflation. In general, when we talk about interest rates, we can talk about so-called nominal interest rates and so-called real interest rates. Nominal interest rates is what we've had so far. Same thing as a quoted rate or a stated rate, the rate that's given. What is a real interest rate? It's the rate that's adjusted for inflation. Let me start with a simple example. Let's say you put your money in a bank account that offers a 5% interest per year, right? And so at the end of the year, you'll be 5% richer, right? If you leave your money there for the full year. But let's say something else is going on during this year. Everything you typically buy gets more expensive. Let's say everything is 3% more expensive at the end of the year. So how much richer do you really get with a 5% increase in your money at the bank and 3% higher prices? You probably already figured out that you'll feel only 2% richer because 3% is kind of eaten by inflation. And this is correct. So we say the nominal interest rate is 5% that you earn in your bank. The real interest rate is only 2%. And the difference is the 3% inflation that sort of erodes the value of your money. Now let's look at it a bit more formally, because actually the math I just explained is only approximate. So let's see how we would do it more accurately. Let's start with something simple. You deposit $100 in your bank account. The interest rate that the bank offers to its depositors is 10% per year. We also know that prices are expected to rise over the next year by 3%. That's inflation. The inflation rate is 3%. The question is, what rate of return do you really earn at your bank? In other words, what is the increase in your purchasing power? So how much wealthier do you really get by the end of the year? So let's imagine this timeline with 2 points of time marked on it, this year or right now, and next year, 1 year later. And let's talk about this whole purchasing power concept. What it really means is how much stuff you can buy, so in units. For example, let's say you're buying jeans, and since we're talking about $100 to be put in your bank account, let's say to buy one pair of jeans today, you would need to spend $100. So what is your today's purchasing power in terms of pairs of jeans? You have $100, you divide it by the price to buy a pair of jeans, so 100 divided by 100 gives 1. Your purchasing power the purchasing power of your $100 today is one pair of jeans. You can use $100 that you have now to buy one pair of jeans, right? And now let's calculate how that would change in 1 year. We're going to use the same steps. Your purchasing money will equal the money you have in your bank account in 1 year divided by the price for a pair of jeans next year. We know that the bank pays you 10% interest, so your money in the bank will increase by 10% compared to today's $100, right? So we have $100 times 1 plus 10%, just like in chapter 5, a single cash flow, future value. And we divide it by the price for a pair of jeans next year. We were given a 3% inflation rate, so the jeans will cost $100 times 1 plus 3%, which is $103. So now we have 110 divided by 103, and that equals 1.068 pairs of jeans. So today your $100 can buy one pair of jeans. Next year, you will be able to buy only a little, 1.068 pairs of jeans, a little bit more, which is a good thing. These two circled numbers, so 10% increase in the money in your bank, right? And 6.8% increase in the purchasing power are the two types of interest rate that we are now differentiating on these slides. 10%, like a pure increase in the money you have, right, in the bank, is the nominal interest rate. And you might recall that the word nominal came up when we were covering the topic of effective annual interest rate. So that's how the financial calculator calls the stated rate. It was nominal. And then the increase in the purchasing power, which is 6.8%, right, over 1 year. That reflects how much wealthier you really get, considering the increase in the cost of living. And that's the real interest rate. And if you look at, the numbers that we use to find the real interest rate, you can kind of cancel out the $100, right? They become unimportant. And so what really determines the real rate is the fraction with 1 plus the nominal rate divided by 1 plus the inflation rate. Another thing you can notice is that the difference between the 10% nominal rate and the 6.8% real rate is 3.2%, right? And that's approximately, it's very close to the 3% inflation that was given. So 1 plus the real rate is calculated by taking 1 plus the nominal rate and dividing that by 1 plus expected inflation rate. Using notations, the real rate is lowercase r, the nominal rate is uppercase R, and you can think of it as the nominal rate typically being higher, so it's an uppercase, and you divide by 1 plus h, so h stands for inflation rate. Because there are 3 notations in this formula, there are 3 things you might be asked to solve for, either the real rate, or the nominal rate if the real rate is given, or the inflation rate if both the real and the nominal rates are given. So we can rearrange this formula to solve for lowercase r, uppercase r, or h. This formula here that calculates the nominal interest rate is known as the Fisher effect. So the nominal interest rate, uppercase R, equals 1 plus lowercase r, and then that whole thing is multiplied by 1 plus h, and then we subtract 1. If instead we rearrange the original formula to solve for the real interest rate, or the lowercase r, you would get a fraction with 1 plus r in the numerator, 1 plus h in the denominator, and then you subtract 1. If instead you want to solve for the inflation rate, which is lowercase h, then you also have a fraction with 1 plus capital R nominal rate in the numerator, and in the denominator you have 1 plus lowercase r, or the real interest rate. And then you subtract 1 from the whole thing. These three are like the most accurate ways to compute the real rate, the nominal rate, or the inflation rate. The approximate versions are these. For the real rate, you do nominal rate minus inflation. To find the nominal rate, you do real rate plus inflation. And to find the inflation rate, you do nominal rate minus real rate. This will give you approximate answers, which are a little bit off. So in our example, we had a 10% nominal rate, a 3% inflation rate, right? If we are asked to find the real rate, we could do it using the exact Fisher effect or using the approximate Fisher effect. By plugging in 10% and 3% into these formulas, we get 0.068, like we had earlier, and 0.07, right? So this is the approximate real interest rate. Let's look at this example. These days, the interest you earn in your checking account is pretty small. It's very close to zero. So let's say last year, in the year 2018, you kept your money in a checking account which was offering a 0.5% interest. I looked up the data on an official source, the Bureau of Labor Statistics, to see what the inflation was like in the year 2018. And this figure here shows that for all the things you are buying for your everyday life, which includes food and paying for gas for your car and everything else, the prices went up by approximately 1.9%. What does it mean? So let's answer the following question. How much richer did you really get in 2018? If you earned a 0.5% interest on the money in your account, but prices went up by 1.9%. So let's do the math both exactly and approximately. Let's start with the approximate solution. To find the approximate real rate of return, you need to take the nominal rate and subtract the inflation rate. That's 0.005 minus 0.019, which gives a negative 0.014. That's the same thing as a negative 1.4%. So you lost 1.4% of your money. What does it mean? You might as well just have spent it last year, because if you didn't, you would have lost it, and you did. This is how much you really lost. That's how much less the money could buy you. The exact formula gives a very similar number, and this is actually the most accurate result. Negative 0.0137 or negative 1.37%. So this is the loss in your purchasing power. This is how much less stuff your money was able to buy you at the end of the year 2018 relative to how much you could buy at the beginning of the year 2018. Let's look at another example. You want a 10% real return. You expect inflation to be 8%, and the question is, what should be the nominal rate of return on your investment, right? So what should be the nominal rate of return so that your real return is 10%, considering the 8% expected increase in the cost of living. So here, 10% is the real return, and we need to find the nominal rate. So it's the capital R that we need to solve for. The approximate solution is real rate plus inflation. So we add together 10% and 8% and get 18%. The exact solution will be just a little bit more complicated. So you would do 1 plus the real rate. Then you multiply that number by 1 plus the inflation rate. And then you subtract 1. So 1.1, that's 1 plus 0.1 in decimals, the real rate, times 1.08, which is the same thing as 1 plus 0.08, the inflation rate. And then you subtract 1. And when you simplify it, you get 0.1880, or 18.8%. So approximately 18%, exactly 18.8%. The two answers are pretty close. I would say always use the exact formulas, because that's how you get the right answer. Anything else is only approximate. So don't use the approximate formula unless you're asked to find an approximate answer. Just always stick to the exact versions for all the formulas we had. And the last topic in chapter 7 on bonds is related to called term structure of interest rates. So let's recall what we had so far in chapter 7 on bonds. We looked at what bonds are. It's basically a way to borrow money. A company can borrow money by selling bonds, or a government can borrow money by selling bonds. We looked at how to calculate bond value. Then the topic of inflation that we just finished has to do with yield to maturity, the IY in the financial calculator, right? The return on your money when you buy a bond. Now, this topic, term structure of interest rates, goes in a little bit more depth into this, how the nominal interest rate on bonds, or IY, is determined. Term structure of interest rates, so the word term means the number of years. So time to maturity, how that determines what the nominal interest rate on a bond would be. There are three important factors that affect the nominal interest rate for different bonds. First, the real interest rate. So when investors are buying bonds, why do they do that? Because they want to end up with even more money in the future. They want to get some return. So there's this bare minimum return that investors would like to get. That's the real return, right? The real interest rate. We already know what it means. So they want to be able to buy more stuff with their money. So the real interest rate captures that adjustment to any possible inflation in the future. So regardless of how long the time to maturity on the bond is, whether it's only 1 year or 10 years or 30 years, we want some bare minimum. So you can imagine this, flat line with the years to maturity on the bond on the horizontal axis and the nominal interest rate on the bond on the vertical axis. The second factor that affects the nominal interest rate for bonds is called inflation premium. Inflation premium means, let's say, investors think that, or there is this general belief that prices will keep going up, which is probably true in real life, right? Then, if you're buying bonds with more years to maturity, you will want to get a higher return. so that you are compensated for that increase in cost of living in the future, right? If you instead hypothetically expect the prices to go down over time or a deflation, then bonds with a longer time to maturity can offer a lower return to their investors, right? We don't need that compensation for the higher cost of living because that's the opposite of the expectation of inflation in the future. And now you can combine the first two factors and sort of imagine stacking these lines on top of each other. So you have the flat line from the real interest rate that we desire, and you take the upward sloping inflation premium line and add it on top. So now we have this upward sloping line shifted up by the amount of the real rate. The third thing that's also very important is something which we already had earlier in chapter 7, interest rate risk premium. So what we had earlier in this chapter was the idea that turns out that bonds that have a longer time to maturity fluctuate in their price a lot more when there is any slight change in interest rates. And so what this implies is that if you're an investor, if you're buying bonds and the bonds you're buying have more time to maturity, you know that your bonds will be fluctuating in their value up and down a lot compared to bonds with fewer years to maturity. And so because you'll be facing this interest rate risk, you will want to be sort of compensated or rewarded with what? Rewarded with a better return on your money. That's why we have this upward sloping line, which basically summarizes the idea that when you're buying a bond with more years to maturity, you want to be compensated with a higher return, right? To offset this interest rate risk. And now we have 1, 2, 3 factors, and you can sort of stack the 3 lines we get on top of each other and get something like this. Upward sloping term structure or relationship between the time to maturity on a bond and what the nominal interest rate for it should be. The line slopes up, in which the 3 factors are sort of put together. It could be a downward sloping term structure, a downward sloping line, but that's only because we expect deflation. So the inflation premium goes down. I would say this is an unrealistic case because we all know how things are only getting more expensive over time, right? Most things we buy, they get more and more expensive. Apart from those 3 factors that determine the nominal interest rate for bonds with different times to maturity, we have 3 more additional factors, but they're not true for all bonds. They're true for some bonds, but not all. For example, on one of the earlier slides in which we looked at different types of bonds, we saw that corporate bonds and municipal bonds have a risk of default. So corporations and local governments that issue bonds may go bankrupt. And so investors who buy those bonds may not get their promised coupon payments, right? And so if you are an investor who are buying corporate bonds, then you are aware of the fact that you're facing this default risk, right? And so you're only going to be interested in buying the corporate bonds if you're compensated appropriately. And the compensation will again come in the form of a higher return on your money. So corporate bonds and municipal bonds, those that include this default risk, right? They have this default risk embedded in them. They will be offering a better return, so a higher nominal interest rate, Then the other types of bonds. So what's left here? The federal government bonds. Then number 5, again, this is a factor that is true for some bonds, but not all. So we had corporate bonds, federal government bonds, and municipal bonds. Corporate bonds and federal bonds pay coupon payments that investors will need to pay tax on. Investors that buy local government bonds, they don't need to pay taxes on that additional income, right? The coupon payments that they receive. And so in order to make corporate and federal government bonds attractive to investors, the return must be higher. That's the taxability premium. And the last thing that actually never came up anywhere in this chapter is known as liquidity premium. So what else could investors require a compensation for? Some bonds are difficult to find. They're not traded very frequently. That's corporate bonds and municipal bonds. Federal government bonds are actually traded very actively, so they're very easy to buy or sell. And so corporate and municipal bonds that don't sell very frequently are said to be not very liquid. And because of that, investors who are willingly buying corporate or municipal bonds are only doing that because they know they're compensated. So liquidity premium is basically that extra, like a little bit of return, so maybe another 0.5% or whatever that might be, that investors receive when they buy bonds. So to summarize all these words, premium, so what does premium really mean? It's an additional return, a little bit more higher percentage. So maybe another 0.25% here and there. So that's the extra percentage return that some but not all bonds have, depending on whether the bond issuer may default or not, whether you as an investor are required to pay taxes on your coupon income or not, and whether the bonds you're buying are liquid, so easy to find, easy to buy or to sell or not. And here we see an example of term structure of interest rates for federal government bonds. So on the horizontal axis we see 1 month, 3 months, 5 years, 10 years, 30 years. That's time to maturity, right? And on the vertical axis we have yield in percent. That's the yield to maturity. That's the nominal interest rate for bonds with different maturity. The line slopes up, which means it's an upward sloping term structure. So for all those various reasons, and we have a total of 6 of those summarized on the last couple of slides, federal government bonds that mature after more years offer their buyers, their investors who buy them, a better return, a higher nominal return. The lower line on the bottom here is the real rate. So the difference between the higher line, the nominal rate, and the lower line, the real rate, is the expected inflation. So we can even calculate it's roughly a 2% inflation 30 years from today. And this graph is about a year old. So it's from end of December 2017. Let's summarize chapter 7. We looked at bonds. That's how companies and governments can borrow money. For bond calculations, we did 2 important things. How much a bond should sell for, or finding the bond value. For that, we need to know the coupon rate that allows us to find the coupon payment, the PMT, in the financial calculator. The time left to maturity, so between today and when the bond will mature. That allows us to find the number of coupon payments, or N. Yield to maturity, that's another term for discount rate or interest rate. We also refer to it as the nominal interest rate in this chapter. That's IY in the financial calculator. And we also need to be given the face value, which becomes our future value, FV, in the financial calculator. The face value is typically $1,000. So you should always assume it's $1,000 if it's not even given. Then we looked at how we would instead calculate the yield to maturity, IY, when the bond present value is known. We also looked at so-called interest rate risk. So bonds which have either a longer time to maturity or a lower coupon rate fluctuate in their value a lot more when interest rates change. We looked at different types of bonds. Some bonds don't pay any coupons. They're known as zeros. Other bonds that pay coupons pay varying amounts of coupons. They're known as floating rate bonds. Then coupons are taxed. So you as an investor, when you receive your coupons, do you need to pay taxes or not? You do need to pay taxes. Do you need to pay taxes on the coupon payments you receive or not? You do have to pay taxes on your coupons if you bought a corporate bond or the federal government bond. If you bought a municipal bond, you do not need to pay taxes. So for municipal bonds, coupons are not taxed at the federal level. Then we looked at the topic of inflation. And the formula we had is known as the Fisher effect. It says that when you earn some return on your money, whether it's in a bank or some other investment, but when at the same time the cost of living is going up, your ability to buy stuff with your money is sort of, eroded by this inflation rate. And so the real or the true interest rate you earn in a bank or in some other investment is approximately equal to the nominal interest rate that the bank quotes minus the inflation rate. This is the approximate Fisher effect, and we also saw as a different version of it in which the calculation of the real interest rate is done more accurately. And then we looked at the so-called term structure of interest rates. So that's 6 factors that determine the nominal interest rates for bonds with different time left until maturity. And to finish chapter 7 on bonds, this is the James Bond Island. It's in Thailand. I traveled there in December 2011. This is me right here. And I saw this very famous island. I think it appeared in actually a lot of movies, but in particular in one of the movies with James Bond. And that's where this informal name came from.